Wall Street may have a problem. One of its favorite recession indicators has been flashing warning signals for more than a year, but we haven't seen one yet. So is the indicator broken, or are we in store for a slowdown? Julie Hyman joins us now for a closer look. Julie.
Yeah, this is something that the Wall Street Journal highlighted today, that it has been something like 400 trading sessions that the yield curve has been inverted. That's the difference in this case here between the 10-year yield and the 2-year yield. And every time we've seen it invert, in other words, the 10-year go below the 2-year, we have seen a recession. This goes back all the way to the 80s. We have inversion here that is going below zero here. Then there was a recession. Going inverted here, recession. Inversion here, recession. Inversion here, recession. It even had inverted before the pandemic induced recession. So now we have the inversion that is going on 23, 24 months, which is exceptionally long in the tooth to last before we see a recession. Now, to back up for just a second here, what even is a yield curve here? We're talking about the difference between long-term and short-term bonds, the yield on long-term and short-term bonds, and it looks at the relationship between the rates of interest. We tend to see this inversion when the market anticipates a rate cut coming from the Federal Reserve, and that's why we see those long-term yields slip below the short-term yields. So very long here, and sort of adds up with all the other confounding economic data that we've gotten recently, Josh.
So do we have a why here, Julie? What explains this conundrum?
So it effectively seems to be that people got it wrong what the economy was going to do and what the Federal Reserve was going to do. Recall in 2023, it was very difficult to find an economist or a market strategist that predicted that the economy would continue to expand and that stocks would continue to expand. So there was a lot of pessimism that got sort of baked into this inversion. As we know, this is sort of the Federal Reserve rate cut that has not arrived. And so the longer that goes on and this inversion goes on, the longer it just says that people were wrong about their predictions effectively. Even the guy who sort of popularized this thing is quoted in the Journal. Campbell Harvey, who's now a finance professor at Duke, said he can't rely on a single measure to be sort of this magic predictor of recessions, even though its track record has been very good in the past. And combine that, Josh, as I said, with, we got a lot of other confusing indicators out there right now. You had a consumer confidence reading today that came in with a rebound for the month of May, but that's not necessarily reflected in other figures. So in other words, it's really hard to be an economist right now and try to predict, and to be a market participant trying to figure out if and when a recession is coming.
It is indeed. Julie Hyman, thank you. Appreciate it.